Good day and welcome to the second quarter update. Looking at the first half of the year, the capital markets have had a challenging time the world over. The Russia-Ukraine war, together with aggressive lockdowns in China, reignited supply-side concerns, lifting already high inflation projections. Furthermore, a more aggressive tightening of financial conditions ignited fears of a global recession. As global central banks focus primarily on fighting inflation, a policy-induced slowdown in the global economy is likely to ensue, with the fundamental backdrops for both global equities and global bonds expected to remain poor. Once the inflation trend reverses, the fundamentals for bonds should improve, while equity fundamentals may stay weak until there is sufficient clarity about the extent of the ensuing growth slowdown. After recent sharp market moves, global bonds now offer better relative value versus equities and could be a hedge during potential further equity drawdowns, particularly when recession fears rather than interest rate concerns are the cause. For the second quarter of the year, the MSCI World Index was down 16%, and the MSCI Emerging Markets Index was down 12% in base currencies. In rand terms, the 12% depreciation that we've seen of the rand to the US dollar could have mitigated some of this, with the MSCI All Country World Index returning a smaller negative of 5.7% and the FTSE World Government Bond Index up 1.8%. The global property index is down 8.3% and the rand closed at 16.38 to the greenback. Of course, the severe power cuts that we have faced in South Africa and growing concerns about the ability of Eskom to power long-term growth in the country, along with political turmoil, have been the main pressure points on the rand. Much like 2021, household spending is likely to be the primary driver of local economic activity this year. As we have already experienced, surging fuel and food costs have led to a jump in forecasted headline inflation. The recent decision by the SARB to hike rates by 75 basis points signals that the rising persistence in inflation is no longer transitory, but split views of the members of the Monetary Policy Committee reflect the extent of the uncertainty that is prevalent in our markets. Locally, the all-share index was down 8.3 for the first half of the year, 11.7 for the quarter, while the top 40 and the CAPS Wix were also down 11.8% and 10.7% respectively. The 10-year government bond yield closed the quarter at 10.5%, while the all bond index was down 3.7 for the quarter. The cash benchmark delivered positive returns of 1.2, while the listed property index was down 11.6. Our portfolios across all the ranges have very pleasingly outperformed their strategic benchmarks. Despite absolute negative returns, the blending of the strategies we employ, as well as the wide diversification in the portfolios, have been of tremendous value add. However, the low return environment does mean that the CPI targets have been a little bit more challenging to beat. Looking forward, due to cheap absolute and relative valuations, SA equities could either hold up relatively better during global equity drawdowns or at least provide better returns during subsequent recovery phases. Not only are the real bond yields attractive versus global yields, but they're also higher than their historical average. Inflation-linked bonds should receive fundamental support from monthly inflation accruals and break-even widening in the coming months until local inflation peaks. Meanwhile, the prospective SA real cash yield has been rising from a low level in line with the Reserve Bank's policy rate increases. Lastly, the property sector fundamentals remain negative, but there has been some improvement, with property values stabilizing and balance sheets improving, with earnings recovering from a low base. That's it for this quarterly update. Thank you for joining us. Goodbye.